I think they're going to hold. I was of the opinion even before the inflation data yesterday that they would be done with the cycle already, that they would not be a July hike. Granted, there's a lot of data to go between here and July. But I think given the weakness in the U.S. economy is going to start to be registered in the upcoming data fairly soon. Credit contraction is real and it's impacting firms' ability to finance. So I think the Fed will look at that and feel that the job is done and go on hold.
What's the Goldilocks scenario for the markets here?
Goldilocks is far away right now. We're still going to be in something that looks a little like stagflation with slower growth, not necessarily negative growth, but not very positive either, with inflation still stubbornly high. So although I think the Fed is going to be on hold from here on out, I think that we'll continue to keep rates relatively elevated because inflation is going to stick around and probably not get to 2% until at least 2025.
Pause. Good morning to you, John.
Good morning.
And I hate to bring up research from another house, so
No
I'll
problem.
just hold. One of your US peers has put out a really interesting piece in the last 24 hours talking about what a pause means, and I wonder if you agree with them. And I'll just go through it. I'll tell you who it is. It's Goldman's because it's their research. They say pauses are fairly common. Some central banks, such as the RBA and BOC, more likely to pause than others. Pauses can be relatively short, with hikes resuming generally 2 to 3 meetings afterwards as well. Third, pauses end when unemployment rates decline and inflation accelerates. But fourth, this is the point I'm interested in. Conditional on a pause and restart, multiple hikes are subsequently delivered in approximately 80% of instances. And I think that's really interesting. Yeah. Pause, as far as the market is concerned, is yay, cut later. Right. And I just think that's the wrong mindset. It may be the case, but it's just the wrong mindset to go into this with.
I agree. I'm going to take a wishy-washy middle ground between that piece and what you said, that rates are not going to come down anytime soon, as I said. I think they're going to stay at least until December, if not into early 2024. Pauses in the U.S. are quite rare, actually. So since the Volcker Fed, we've had one instance, well, if you don't count the 2014 hike, which led to a year of no more hikes. But in 2016 and 17, there was about a 6-month pause. That's the only time that we've had a pause and then a resumption in rate hikes thereafter in the U.S.
And taken on board everything you've said, and I'm not going to disagree with you, of course. Sure. But this is a very, very historically different time, isn't it, given what we're seeing? So. Sure. And again, I keep harking back, as do too many people, back to the 70s and that as well. But the fact of the matter is, this is a very important phase that they didn't get wrong. Otherwise, the legacy for Powell, the legacy for the administration is going to be in tatters.
Absolutely. And credibility is very important to the Fed. And one could argue that they've lost a bit of credibility with the whole transitory story.
One could argue that, couldn't we?
One could easily argue that.
They admitted it, haven't they, John?
What's that?
They admitted it, didn't they?
They did admit it, and we all kind of knew it. I was never on the transitory camp to begin with, and a lot of other my peers and colleagues were as well. But I think the difference this time is that the economy is really going to start to weaken, particularly because of the SVB and banking sector stresses we saw in March and April. We've seen balance sheets shrink, particularly for small and medium-sized banks, who are the funders for small and medium-sized businesses, who are the generators of job growth in the United States at the current moment. So if those firms can't get financing, can't roll over debt, can't expand because credit's difficult to obtain, they're going to stop hiring. And that's going to start to see those job openings come down, which have been so high lately, and then we'll start to see more people entering the labor force without able to find a job. Unemployment will go up. Fed saw 4.5% unemployment at the end of this year. The new dots will probably come out and show something around 4.2, 4.3. And they're quite comfortable to keep rates high, even with that sort of deterioration in unemployment.